Welcome, everybody. Thanks for joining the session. We'll cover, as was noted, securitizations of private equity funds, otherwise known as PE CFOs. We've done some presentations around this in the past, and so we assume that some folks are familiar with the space, but there may be some others who are not. And so what we're going to do, we'll do a very short primer, a few minutes, and then we'll get more into the more recent trends in terms of the performance of these vehicles through the recent downturn, regulatory considerations, and some of the recent deals. Okay, so just to start off, what is a PE CFO? So a PE CFO is a securitization of a portfolio of private equity style funds. It doesn't have to be buyout, it could be growth, venture, real estate, credit funds, etc. Any type of drawdown type fund with an investment period and a term life. What happens in the securitization? In the slide that we're seeing here is an example. So let's say, for example, a secondary fund is acquiring or has acquired a portfolio of 50 LP interests from another investor. So that's the box on the left. Those LP interests will be transferred into a new SPV. That's the middle box, and then the SPV essentially will issue tranches of debt and equity. So it can be, for example, a typical capital structure could be, say, 50% senior tranche, maybe rated single A, another 10 or 20% mezz tranche rated, debt tranche rated, let's say, double B, and then the equity, which in this case would be 30% in this example. And let's say the secondary fund would retain the equity, and the senior and mezz debt would be sold to external investors. Typically, these are going to be insurance companies, asset managers, hedge funds. Investors would typically buy other forms of structured finance, could be CLO debt or esoteric ABS, such as aircraft securitizations, etc. And then the notes of the PE CFO are repaid from cash flows generated by the underlying funds. So as the underlying funds distribute cash, that goes to pay the fees and interest on the PE CFO. And there's going to be an amortization schedule that will determine how much money goes to the senior mezz classes. And then as long as certain thresholds are met, for example, in loan to value or LTV threshold, the equity can also receive some of the residual. The transactions typically also have other parties involved. For example, there will be a manager who will manage the transactions, meeting capital calls from the underlying funds, etc. There will be a liquidity facility in many cases, because in a downturn situation, distributions from the underlying funds may be reduced, and a liquidity facility will help bridge the liquidity gap to make sure that the PE CFO can continue meeting its required expenses and interest on the notes. So that's kind of the basics, and I'll turn it to Alastair to discuss a little bit more on motivations and types of sponsors we're seeing.
Thank you, Greg, and allow me to add my welcome to everyone who's attended. Thank you for dialing in. So the type of sponsors that we've seen in these transactions show some variety. The most important type of sponsor so far post-crisis has been sovereign wealth funds, where Azalea, which is a subsidiary of Temasek, the Singaporean sovereign wealth fund, has been particularly active in this sector. More recently, we have also seen insurance companies becoming increasingly active in this sector, both on a private basis and on a public basis. Now, the reasons that we may see some of these entities engaging in a securitization of a private equity portfolio could include an alternative to a direct secondary sale. So in this format, rather than simply selling a portfolio of funds outright to the market, a sponsor may effectively retain the equity component and sell debt, thus generating cash flows and acquiring a levered return on the equity piece. We've seen it used as an alternative financing tool, can also obviously just for leverage to influence the economics of the transactions. And lastly, and this is a point that I'm going to come back to slightly later in the presentation, we have seen some entities, in particular insurers, looking to use the securitization framework from a regulatory capital perspective. Now, that is quite a complex area, and we'll come back to that later on, but it has certainly been important. Greg, if you can move on to the next slide. So how do we model the private equity securitization transactions? So as Greg mentioned, our role here is to assess the ability of the transaction to repay the debt in full and on time, and obviously to make any interest payments during the lifespan of the transaction. We rate to the documentation, so we'll typically be rating to a relatively long legal final maturity, although in practical terms, the cash flows generated by the portfolio may well mean that the debt is repaid in relatively short order. What you can see here is a portfolio. It is a sample portfolio. It is a fairly representative portfolio of private equity funds that we might see. And you can see here that the launch year is 2004. So this is a private equity securitization which was launched in a fairly benign period, and it was a relatively well-seasoned portfolio. And by that I mean that it was fairly cash distributive. If you look at the slide on the right, you can see how the cash distributions, that's the blue lines, are being distributed to the different parts of the capital stack. And you can see that a fairly significant part goes to meeting capital calls. You then have going out to the Class A principal, so beginning the amortization that Greg mentioned, paying interest, and then finally paying out the residual cash flows to the equity. In this scenario, the IRR of the portfolio of private equity funds is approximately 20%. The IRR on the equity piece in the CFO structure is 50%. There is a lot of leverage here, roughly 70%. So this is a highly geared transaction and launched in a fairly benign year. Now, Greg, if we could move on to the next slide, we have a rather different scenario. So in this case, we have effectively the same portfolio, but launched in 2008. So this is an adverse year for launching the transaction. And just simply looking at the chart on the left, you can see that the magnitude of distributions from the portfolio are substantially lower, but positive, in fact, in most cases, than they were in the 2004 example on the prior page. That feeds through to the chart on the right, where you can see that the cash proceeds are distributed slightly differently. And the one thing I'd highlight here is the use of the credit facility, which you can see is, or at least for those of you who are slightly less colorblind than me, may be able to see that the credit facility is drawn in one of the periods and is then subsequently paid back in a later period. In this case, the IRR on the portfolio would be 4%. The IRR on the equity piece in the CFO structure would be 3%. So still a positive return to equity, but clearly the operating environment in which this CFO existed was much more negative. But it came through that stress period and survived. And as the equity return was positive, it means that the debt, which is where we are primarily interested, would have been paid in full. Greg, back to you.
Thank you, Alastair. And so I'll spend a couple of minutes talking about the market in general. So PE CFOs are actually not a completely new vehicle. There were PE CFOs developed from the early 2000s. You can see on this chart. There are not a lot of transactions to go off of, but there are a few of these deals that were done pre-2008 financial crisis. A few of them actually went through the 2008 financial crisis and did fine. As you would expect, the NAVs of the underlying funds and therefore of the PE CFOs declined significantly during the downturn, which in some cases would trigger certain thresholds that would then help protect senior note holders. For example, it would end an investment period, or it would be direct cash flow away from the equity and junior note holders to more senior note holders. Following the 2008 financial crisis, there were no deals done for a couple of years. One, given the more complex nature of these transactions and just an aversion to more esoteric types of structured finance deals. And then in 2014, the market restarted with one deal and took a couple of years to slowly gain traction. And I would say now there's quite a bit of momentum behind this asset class. Does not show up yet in that many deals, as the chart shows. However, we would have expected a number of deals to have happened in 2020, and there were a few kind of in a pipeline before COVID hit and led to the market downturn and volatility. And so I think that's really the driver of the slowdown in 2020. I think some of those deals might get pushed to 2021. And this just shows some of the recent deals that Fitch has rated. The most recent one, all the way on the left side, is a CUNA Mutual sponsored deal. CUNA Mutual is a life insurer in the US. They've been investing in private equity funds for many, many years. And as you can see, they are a repeat issuer, PE CFOs. They're in fact the ones that restarted the market in 2014. Did another deal in 2017, and then now right after the most recent downturn, again restarted the market, and with the last deal in October. Other repeat issuers are the Temasek sponsored deals that Alastair mentioned, and then you have some one-off deals like Sideway Capital, which is a kind of a family office type portion of a hedge fund manager. And again, any type of LP with a diversified portfolio of LP interests could sponsor a PE CFO, given the motivation that Alastair mentioned. In terms of some of the characteristics of the funds or the transactions, as I said, they're diversified by fund and by GP. You can see number of funds range from the low 30s to more than 100. Credit enhancement is quite high relative to other structured finance vehicles at similar rating levels. The credit enhancement for single A rating ranges from 50 to 70%, and other tranches are rated between single A, triple B, double B areas, depending on the riskiness of the portfolio and the structure, the level of leverage. And I'll speak a little bit about the recent performance of these deals. You can see on this chart on the left side, we have a couple of quarters of global private equity exits from the 2008 era. And on the right side, we have similar data points from more recent period. And what I'll first point you to is the 2008 era. You can see that once the stress started in the first quarter of 2008, there was some decline in exit, some recovery in the second quarter, and then in the third quarter of 2008, the real downturn started there. And you can see 5 quarters of fairly low exits relative to previous years. In the more recent downturn, which we're not quite out of yet, as we see the second wave of COVID hitting now and potential shutdowns, and we'll see what that does for to the economy and the markets. But you can see that in the first quarter of 2020, there was some decline from 4Q 2019. Those clearly was not as severe as what we've seen in 2008, and then in the second quarter of 2020, we've seen more of a decline. Still not quite as bad as what we've seen in 2008. And then taking into account the third quarter, which essentially shows a lot of the pent-up demand or pent-up deals that could have happened in the first or second quarter of this year, kind of made it out in the third quarter. And so you see that very fast recovery, and then we already see pretty decent level of deals in the fourth quarter. So it's left to be seen what happens in the next few quarters if the pandemic resurges and the economy takes another turn down, markets decline, and that could again impact exits. So how does this impact PE CFOs? Well, PE CFOs, as Alastair described, they depend on the distributions coming in from the underlying funds. And so for most of the funds that have buyout type of exposure, they're relying on capital markets for these type of distributions. And we've seen these kind of trends as seen on this chart play out in the PE CFOs themselves, where sometime in the spring, distributions have declined quite a bit in some transactions. But in other transactions, they really stayed fairly stable. For example, if a number of deals have much more significant exposure to tech or healthcare related sectors, and really distributions there remain quite stable. In other deals, for example, where there is more energy focused exposure, those type of transactions have seen much bigger declines in distributions. And so from a cash flow perspective, we're not quite as strong. The other side of PCFOs, as we mentioned, are capital calls. And from a liquidity perspective, PCFO needs to generate enough cash flow into the distributions to meet capital calls and interest. What we've seen in a number of the deals is capital calls actually increased around the time of the market volatility. And that's primarily driven by defensive positioning from the underlying funds, where GPs are calling capital to support their portfolio companies, as revenue decline, and they're looking to have liquidity on hand. There are fairly limited number of completely new investments, where GPs of younger funds are calling capital to invest in opportunities. I think that did happen to some extent. We've seen a bit more that GPs of existing funds or with existing portfolio companies would call capital to make bolt-on acquisitions. So there's definitely some taking advantage of the opportunities presented by the downturn and the lower valuations, particularly in sectors where GPs felt would do fine through the pandemic. And so from the liquidity perspective, all of the deals that Fitch rates continue to have sufficient liquidity. In some cases, distributions would not be enough to meet capital calls, but the deals would have cash on hand or, as we mentioned, liquidity facilities that could bridge those liquidity gaps. Though so far, liquidity facilities have not been drawn on. So for the most part, kind of internal liquidity or cash on hand has been sufficient to meet capital calls and make interest payments. And now in the later quarters of this year, distributions have recovered. So the deals are in better position. So far, the deals have performed fine. We did review all of our rated transactions earlier in spring, I think in April, and we affirmed most of the tranches. We ended up upgrading actually one tranche given continued deleveraging. So distributions remain strong and they have a strong or a more aggressive amortization schedule. And so the notes were further delevered. In some cases, we have placed notes on negative outlook. So we thought, that it looks like they would be fine, but obviously there's a lot of uncertainty in terms of where valuations and distributions would go. I think where we stand now, it looks better than what we expected back then. And we ended up downgrading one transaction from single A to triple B, or one note from single A to triple B, given a very high exposure to the energy sector. Again, I would say that that deal's portfolio has performed a little bit better than we actually expected, given fundamentals in the underlying funds, for example, hedging programs that would limit kind of the real impact from the decline. I'll stop there and turn it back to Alastair.
Yeah, thank you, Greg. So we wanted to spend the last part of the presentation talking a little bit more about insurers and their approach to private equity. And the reason we single out insurers for further attention is one, insurers have been active in the private equity CFO space. We've had 2 transactions we rated in the recent past have been sponsored by insurers. And we know that insurers face a number of constraints, which they're looking for solutions for effectively. And what this boils down to is the issues that an insurer faces in one, its return objectives, which it needs to meet in terms of its downstream liabilities, but also the low rate environment impacting on that. On the other, the risk profile that the insurer is willing to assume, and then, and quite importantly, thirdly, the efficiency of a given investment from a regulatory capital perspective. And what we see here is that survey data that's publicly available in the market, I've taken one here from Natixis, there are plenty of others available. This shows that regulation can be a significant hurdle for investors in terms of taking on higher risk asset exposures, of which private equity is a case in point. If you look at the slide on the right, you can see the baseline capital charges for private equity exposures across a range of insurers in different jurisdictions and different types of insurers. And focusing here on Europe, we can see that the capital charges, the baseline capital charges for private equity exposures are punitive. In fact, the most punitive of any of the major jurisdictions around the world. So insurers face capital charges, but we do know that if the format of the exposure is changed, then that can have implications for the capital efficiency of the investment. This is more applicable in some jurisdictions than others. So, for example, in the US, the NAIC has been consulting on private equity CFOs specifically from the capital charge perspective. Greg, perhaps you would like to make a few remarks about the latest from the NAIC.
Sure. And before I start, forgot to mention, please feel free to ask questions through the chat function, I think, and we'll be happy to answer them as they come along, or leave them to the end, depending on where we are with the slides. Yes, so the NAIC for a little bit more than a year now, and sorry, for those not familiar, the NAIC is the insurance regulator, or kind of a regulatory type group in the US, where insurers are actually regulated at the state level. In any case, they've been reviewing PE CFOs for a little bit more than a year, along with all kinds of other types of structures, like principal protected notes and other more bespoke securitizations, where they've perceived some abuses of capital charges, so essentially capital arbitrage, and kind of thinking how to solve those issues. And I think the initial proposals for PE CFO was pretty punitive. Essentially, the proposal was to look through to the underlying investments, and since they are equity holdings, even in debt funds, you have an equity position in the fund. So treat all the exposure as equity, even for PE CFOs, even the senior notes that, for example, could have 50 to 70% credit enhancement, structural features, stated coupons, and all those kind of aspects that appear in a real ABS bond. So a treatment of equity type capital charge would have really been punitive for these types of structures, particularly as insurers make up a big portion of the investor base in these type of deals. Out of their groups, they invest in other ABS. Over the last year, the NAIC has been discussing with the industry and kind of internally how to better differentiate transactions that I guess they deem as safer or more okay relative to the ones that they feel really are more of a capital arbitrage type of transactions. The motivation is capital arbitrage. And it seems like the initial proposal kind of moved in slightly different direction in effort to better define what is proper ABS. And the last proposal that came out in October has essentially defined ABS as transactions where the underlying assets or the cash flow from the underlying assets is the primary source of payment for the notes, and there's a redistribution of risk in the asset pool through tranching, essentially, and they're looking for kind of significant or more than immaterial credit enhancement. So a few of these aspects seem to fit for PE CFOs, though, but I am by far not an expert on regulatory capital, so not a place for me to say. However, the last transaction, the MCA3, was done, was priced and closed right after the latest NAIC call and proposal. And so that indicates to me that investors, enough investors in the issuer were sufficiently comfortable with the direction the NAIC discussions have been going in kind of anticipation of the final resolution. So, Alastair, back to you.
Yeah, thanks, Greg. And what's interesting about that is it is quite consistent with some of the frameworks we see in other areas of the world, apart from Europe, whereby the format of the investment can result in quite a materially different capital charge. So you can see here the baseline capital charges for Japan, for example, is effectively the capital charge for an equity exposure. Now, if that were in a securitized, or even in fact in a re-securitized format, then the capital charge would effectively be really quite significantly lower for a Japanese investor. That's not to say there would necessarily be appetite. There may obviously be many other factors, but it shows that similar to the US and dependent on the jurisdiction, the format of the vehicle can be quite meaningful to the capital charge. Greg, if we flip onto the next slide. The picture is really rather different, however, in Europe, whereby the securitization format, in fact, carries a fairly significant capital charge. So what you see here are the capital charges for Type 2 securitizations. A Type 2 securitization is anything, and I quote from the regulation, anything which is not a Type 1 securitization. And a Type 1 securitization is basically your simple everyday securitization, maybe a credit card deal, maybe a prime RMBS deal, very simple, plain vanilla, or to use the regulatory words, a simple transparent securitization. Something like a CLO would be a Type 2 securitization, and it is our view that a CFO would most likely fall into the Type 2 securitization bucket as well, which means that for those insurers looking for capital relief on their private equity exposures who are based in Europe, there is a very complex trade-off between the risk, reward, and regulatory capital needs of this type of exposure. That's not to say this type of transaction couldn't happen in Europe. I mean, Greg, before the crisis, there were several deals in Europe, I believe. But I think it speaks to there being potentially a different investor base and different sources of demand for this type of transaction in Europe, potentially compared with other jurisdictions around the world.
Yeah, and Alastair, maybe just a question. You had the capital charges for Europe. The UK obviously is part of that. How does Brexit change the situation?
Well, obviously there are many unknowns when it comes to Brexit, and it seems that fishing rights garner more government bandwidth than financial services. But that aside, there is obviously the requirements of alignment with Europe in relation to access to the European market. But one thing which is quite interesting already is that UK insurers typically use the internal model-based approach to their investments, which means they have defined their own model, which they have sought approval and gained approval for through the regulatory authorities. And these types of models will allow bespoke risk weights to be assigned to their exposures, compared with the standard risk weights which are presented here in this slide and which are used by insurers in a more prevalent manner across Europe. So there are already UK-Europe differences in the way that insurers approach investment risk. Brexit may lead to changes, but this would be sensitive to equivalence, specifically the equivalence of the UK regulatory framework with Europe and the implications for market access.
Okay, I think we're pretty much out of time, so maybe I'll just end by saying we have a primer that we wrote on the sector, and for each transaction, there are transaction reports. So if anybody's interested in learning a little bit more about the sector, please feel free to reach out to Alastair and I. Our contact info is at the end of the deck, and we'll be happy to send you the material. And thank you for joining us.